Hello, welcome back to the channel. Thanks for joining me. I'm Anthony Parent with IRS Medic. Now, being self-employed isn't easy. There are multiple levels of taxation. So what are self-employment taxes? How do self-employment deductions work? Let's take a look. What are self-employment taxes? Before we get to this question, let me give you an example of what the traditional employee-to-employer relationship is. The easiest way I can think of explaining this is this. As an employer, I have to pay about 8% in employment taxes. So for each employee, I have to pay 8% of wages to this guy. That's right, because I had the audacity to grow a business and have employees, the government thinks it's a great idea that I'm taxed on my employees' wages. Employers of all sizes have to pay about 8% of all wages to the federal government. These employment taxes allegedly fund Social Security and Medicare. Kind of makes you laugh though when politicians start about creating jobs. Would not the best jobs program would be not to punish those who employ people with taxes? Would it make more sense to tax people for not hiring employees? Well, anyway, now I have about 8% taxes to pay, but my employees have an 8% tax to pay as well. That's right, for the privilege of getting their butts up each morning and hustling hard, they are taxed 8% for that privilege. But as a business owner, I'm able to deduct the 8% I pay. However, my employees are not able to deduct the half that they pay. Now remember this 50-50 split, as it's going to be important in a few moments. So if you add up both halves of the employment taxes, you get about 16%. This is the total amount of employment taxes. Wait, if these are not income taxes, but rather Social Security and Medicare, why are we not writing checks to Social Security and Medicare? You know, this always seemed like a good question to me. The answer is likely twofold. First, the IRS is really good at extracting and enforcing taxes. Does it make sense to create a federal agency with a duplicate role? Would you like another IRS to deal with? The second is that politicians love hiding the cost of things from you. Because if you knew the true cost, there would probably be a lot of tar and feathers. And I'm convinced the confusion is intentional. But wouldn't it be nice to get out of this 16% gouging by not being employed, but say rather being self-employed? What you need to understand is that self-employment taxes hit earned income, not unearned income. Earned income is income you get up every day to go out, hustle, and make. You earned it. Unearned income, according to the IRS, is when you get a check even though you didn't do any work. This is according to the IRS because it sort of ignores the fact that maybe you did work to have that investment that gave you that passive income, such as Social Security, rent, royalties. Some self-employment income taxes do phase out, but seriously, some of it goes on forever and ever. So it's always better to have unearned income than earned income. But that's not really an option for those of us who are trying to build assets. We don't have a lot of passive income. Rather, mostly everything we do could be subject to those self-employment taxes. So now what really can be done? You know, at the outset, remember how I mentioned that 50-50 split of employee taxes? How employees can't write off their employment taxes, but how the employer can? Well, the same logic applies to self-employment taxes. The Internal Revenue Code allows you to deduct 1/2 of your self-employment taxes. This deduction lowers your taxable income, which lowers your taxes too. Unfortunately, though, it wouldn't be better not to be hit with self-employment taxes in the first place. However, there is help available. Thanks to tax reform, there's now something called a qualified business income deduction for the self-employed that can really help offset some of these self-employment taxes. The deduction can be as high as 20% of your business income. Additionally, and this has been the move of many very wealthy people, is to utilize something known as an S Corp. Subchapter S is a form of corporation that meets specific Internal Revenue Code requirements. The requirement gives a corporation with 100 shareholders or fewer the benefit of incorporation while being taxed as a partnership. Now it's confusing because an S Corp is something that even a single member LLC can elect to do. That's right, you don't need a corporation to be taxed as an S Corporation. And one of the prime benefits of an S Corporation election is that you can hopefully say goodbye to a lot of these nasty self-employment taxes. Self-employment taxes and deductions can be confusing for multiple reasons. I hope I've answered a few of your questions, but deciding what you should do is really something you want to talk to someone with solid tax experience about. Thank you for joining me. If you like this video, please hit the like button down below and remember to subscribe to our channel to keep up to date with the latest tax information you need. This is Anthony Parent with IRS Medic.